A very good afternoon. You're watching the newsroom right here on ET Now. I'm Ajay Sharma. The market is flat with a positive bias as far as the benchmarks are concerned. Some activity is witnessed in the broader markets, but nothing great to talk about this afternoon. A lot of cues the market is negotiating, especially global cues. And of course, the first quarter GDP, FNO expiry, a lot of stuff is lined up for this week, but still trying to find a direction as far as the medium term goes. Before we move ahead and get you a very special guest joining us today, all the way from Singapore, Venugopal Garre of Bernstein. But let's get you the top headlines right now as far as COVID updates is concerned. Then we'll have a long discussion on markets. The top 10 headlines, India has crossed the 4,000 mark as far as COVID-19 deaths are concerned. In fact, our country is also ramping up virus testing to almost 2 lakh tests a day. Government, meanwhile, has permitted domestic chartered flights to come up or commence operations. However, as far as passenger flights are concerned, almost 630 flights were cancelled on day one on resumption because a lot of states have still not eased the restrictions of travels. Prices of N95 masks have fallen by 45% as supplies are increasing. And Rajasthan is one state which has allowed public transport even in red zones. WHO, meanwhile, has paused HCQ trial over safety concerns. And Singapore has cut growth forecast for the third time as far as COVID impact is concerned. And UK will reopen shops from the 1st of June as they finally claw back to normalcy. So Venugopal Garre is joining us here. He's live from his home in Singapore. Venugopal, thank you so much for your time today. I hope you're safe there. How is working from home panning out for you? Talk to us about how things are at your end of the world.
Thanks, Ajay. I think I spent more than 2 months at home. So to a large extent, I would probably say got used to the routine, but I would also argue it's probably relevant for India too, given the last 1.5 month of people being at home. I would argue that to a large extent, there are a lot of industries where you see productivity increase. So there's a lot of less hassle of traveling, etc. So I would take it in the positive spirit.
Right. Venugopal, let's talk about your understanding right now. We saw a very interesting and very candid upfront report from you recently. First, let's understand how you are analyzing the setup, the investing landscape for India versus the world. Data shows we are massively underperforming versus MSCI, etc., versus other markets, and the outflows of FIIs continue from India. What's your analysis like right now?
Yeah, I mean, that's right. India, to a large extent, has underperformed most markets globally. And I would also probably put that if you take a dollar lens, then from a dollar terms, probably the underperformance might be more stark. Just to give a quick backgrounder to this, well, a lot of it is COVID-led. I would also argue that COVID probably sort of enhanced or explored or highlighted the India's sort of economic challenges, quite a lot. So to give a context, primarily what we have seen is the last couple of years of a broadly weakish economy, and there were no new drivers of growth emerging, and more importantly, even the cyclical parts such as investment cycle, which was showing some promise of recovery, ended up just largely being in a government cycle. So we didn't really see an ample recovery on that front. And to a large extent, the growth eventually weighed down on consumption, sort of driving it. And that too was, to an extent, credit linked. And a lot of that is unwinding at this juncture. So the cyclical backdrop was not good. We have an impaired financial sector at this juncture. And it's also apparent that beyond a certain extent, the government cannot really buy its way out of these challenges. That's one part of where India stands relative to the world. I would also say the second thing is more in terms of where we are in the COVID cycle. So we've primarily still in the early phase. The wave one continues, and more so, with lockdown sort of easing now, there is always a risk of wave two. This is a very important discussion which we have with most investors. So that's a risk primarily. And the third more important thing is more about where India stacks up in terms of valuations. And I would say if I fundamentally look at India itself on an absolute measure, I would argue we're still not cheap. It's simply because the EPS that you see for a lot of these indices don't really truly represent the real earnings. And I would argue that a lot of cuts may happen, but may not happen at one go. And that's because of uncertainty. You would slowly see cuts pan out through the year as more evidence of challenges or recoveries emerge. So it's going to be both ways, and that's why we think that Nifty per se also at an index level is a bit sort of rich in terms of valuations.
Right. Venugopal, you must be interacting a lot of calls right now with FII clients of yours. What kind of conversations what kind of direction are the conversations moving when India is being discussed? Also, talk to us about how are these large clients of yours, foreign investors, analyzing the measures taken by the Indian government to counter the COVID impact, both from the RBI side as well as on the economic side from the government side?
Yeah, so if I were to first talk about the economic package itself, and the $270 billion number, which also includes RBI's liquidity measures, which are probably close to $100 billion. I think the discussions they're a part of it, which is primarily about the credit guarantees, were probably positive, were really positively taken, because I would say that this has been done globally, and this was required because the bottom of the pyramid, especially the MSME, required some support. Otherwise there would have been second order challenges, especially given that they also employ a fairly large number of people in the economy. Now, but the point is, beyond that, I think there was, concern that there wasn't much in it for, sort of propping the economy from a recovery point of view. So which primarily means that there was not much in it for, sort of driving back demand in the economy. So a lot of these measures, probably that were discussed more about the potential reforms, etc. A lot of that were actually already in the work. Some had been announced earlier, but there were large execution challenges because of which none of that happened. So there wasn't too much of an excitement even around these reform measures, I would say. The other aspect, which is very interesting, is that beyond the scheme of this economic package, I think the worry is our ability to sort of manage fiscal deficit, and whether we need further rounds of stimulus and how that eventually impacts, the currency and, especially sovereign credit ratings. And within that, I would also argue the concern was also about the sort of reorienting of expenses. So if you were to just ensure that you don't really blow up on the fiscal deficit, and if you reorient expenses, things which could happen like cutting capex or the salary sort of wage freezes that we've seen for government employees, etc. So that's actually not really stimulus. So that's the other thing which worries to a large extent investors. So that's on the economic package, honestly. And I would quickly highlight on the second part is what we are discussing is there is a large chunk of foreign investors who want to look through this challenge, because COVID is not really something which was expected, and look for opportunities to increase positions or add to stocks that they've always wanted to buy, but none of them are comfortable that this is the bottom, right? So they're the ones who will probably look at 3-4 year views and look at things beyond the next 12 months when they take these decisions. So there is one sort of an audience who's also looking at the long term from here.
Now let's talk about the most pained area of the market, which was the direct hit, took it on the chin, the financials, especially banks. And understandably so, they are the barometer of the economy. They are a direct play of either collapsing growth or booming growth which we saw in earlier years. How are you analyzing the entire basket of financials? Private sector banks, the premium quality, big 3-4 times price to book ones, the larger PSU banks ones, even insurance has got interest coming from investors. How are you looking at this basket of financials right now? Even NBFCs for that matter.
Yeah, I would put it, financial sector, of course, is underperformed. This is among the so-called risk bucket. Both cyclical sectors such as autos, which is consumer discretionary, or, industrial. So financials is stacked up somewhere in that pack at this juncture. I would argue that, there is not much the financial sector could have done, because and as you know, you can't really do riskless lending. You have to take you have to lend through the risk curve, of course, take, tactical sort of situations at every point of time to, of course, drive growth too. So I would, however, if I were to look at financial sector at this juncture, I would very simply say that, look, the story is not over, So if I were to build in any case for an economic recovery, eventually, it has to be, also led by financial sector, because credit is a fairly important driver for the economy, especially given the state, of where we are as an emerging market country. So within that, some clear trends are emerging, right, where you would probably see a consolidation. This consolidation trend, by the way, is not new. We have been seeing some form of consolidation and, share gains for some parts, of the private sector, gaining share, etc., as an ongoing trend. But the consolidation probably could be more intense, where you have, a couple of larger private sector banks, or maybe even one public sector bank, becoming more relevant as we go forward. The second thing, of course, is, we have seen a mushrooming of, a lot of these NBFCs, a lot of these fintech lenders, etc., over the last 1-2 years. I would say that there would be a rationality to it, because I think even their sources of funding, when they look for funding, was also going to be challenging for quite a few of the smaller names. So even there is a, we believe there will be consolidation. You'll probably see a couple of top ones probably still existing and thriving, but all of them, of course, facing challenges as we, see in the downturn. And third is, as you mentioned, insurance. That could probably be one of those so-called secular growth stories, a news story, which might, last for a while. So that's an area where probably there'll be interest. So in that context, I would argue that this is nothing different, from what we have we tend to see as trends in the past. But this thought process of financials primarily being more as cyclical entities rather than secular growth stories in general is going to probably be an important, takeaway from what we are seeing at this juncture. So how to value these companies is going to be important going forward. You can't really offer a 8x or 7x price to book for, small companies, especially because you feel they are in a high growth cycle. But the point is they're probably taking larger risk too, or they're exposed to parts of the economy which have higher risk. Right. So that's what probably is the way to look at financials. If I look at the next 12 to 24 months, we would, of course, see some elevated NP in certain parts of the lending. And of course, you'll also see, fundraisings happen, as we get more evidence of how much provisionings some of these companies would have to take once moratoriums, etc., get lifted. But putting that aside, the consolidation trend probably is the one to chase or look at eventually, when things recover in the economy.
My last question to you, when we talk of earnings, clearly a lot of people on the street we interact with saying that at least 12 months, 4 quarters, 3-4 quarters, one shouldn't even look at earnings and we should only talk about the next year. How are you looking at this argument? And that's when we're talking about on average. But within this time frame as well, there would be areas which would have earnings growth. Which are the areas you find that strength you're most bullish on?
Yeah, so so if I were to look at this particular year, FY21 rather, I think it would be very wishful to believe that everybody is thinking that we should look beyond this year. I would still argue that it also depends on the nature of investors. So there is a large chunk of investor base who would, of course, be following trends through the year, because there is still an expectation that you would probably see a quick recovery moving into Q3, Q4, right? So if that doesn't pan out, of course, there'll be some disappointments. But then there is another chunk of investing, which as I highlighted earlier, are those who would want to look beyond this particular year and not even look at FY22. Maybe look at how the normalized FY23 and 24 would look like. So there is that set of investor base too who would be approaching stocks in a different way. Of course, they won't take index bet. They will be taking probably specific sector stock bets. So in summary, I would say yes, this particular year may be less relevant, but when it cannot be completely ignored at this juncture. In the other part is about which areas in the economy or sectors we would tend to see some form of growth. See, when you are in a situation where the economy itself is probably extremely weak, the top-down GDP number itself is going to be weaker. At this point of time, it very clearly appears that growth would be missing from the equation from most of the sectors. It's about what kind of what are the truncated profits they can generate. Some of the sectors which are the so-called low-risk sectors, where you might probably still see growth emerge or sustain, is something like consumer staples, for example, where you might probably see things being fine. We would also argue telecom, given the consolidation that we have seen in the last 1-2 years. And IT services, of course, would have a top-line problem, but it all depends on how they're able to, sort of manage their cost structures to ensure they probably end up, seeing some form of a growth. So outside of these 3 or 4, areas or big sectors, I would argue that the rest of the, economy, which is a listed economy, I would put it, would find it challenging to grow over the previous year. If I take FY21 sort of a call on sectors.
Right. Right. All right, Venugopal, I'll let you go on that one. Thanks so much for your time. We'll take this discussion forward, offline mode, because clearly there are limitations of the listed world as far as capturing the entire growth of the country.